We've had 6 consecutive weeks of gains on the JSE, and the market looks really to me that it might just hit the 60,000 mark, would it?
Yeah, look, I mean, I think the bulls are definitely on the ascendancy, which has been quite surprising because foreigners have actually been big liquidators of our equities. They've sold something like 30 billion rand now of our stocks year to date. So foreigners have been big sellers of our equities, and this is generally when they've been quite constructive on emerging markets. So, South Africa hasn't been caught up in that emerging market boom. And I think the primary reason for that is obviously because, we have a lot of concerns around growth. We had the load shedding issue, and our concerns around growth seem to be quite structural. So the foreigners have been staying away from our market. But I think the bottom line is that after the big sell-off we had in 2018, equity markets just got very depressed, and we saw local institutional investors, which were quite underweight equities, kind of using the sell-off in 2018 to get to a more neutral position, and we've seen some strong buying on the back of that. In fact, for the month of April, we're up over 5% on the all-share index. So it's been a really strong return, and it's been primarily driven by the large caps, the top 40 shares. The resource shares have obviously been very strong year to date. Naspers has come back in roaring fashion after being down more than 20% last year. And we're seeing that British American Tobacco going through a bit of a wobble in the last couple of weeks, but strong so far this year, up probably about just under 30% year to date. So the bottom line is that I think it's just about rebounding from structurally fairly depressed levels. And I think on a forward-looking basis, it's really going to be about individual stocks and individual opportunities playing out. And you're quite right, the market could push to 60,000. I think people are getting very depressed about the earnings outlook going forward, but there's still a decent amount of earnings growth there. But now it's going to be about the individual opportunities and unlocking earnings growth and cash generation going forward, rather than the whole market just being pushed higher.
It's interesting to see those banking and retail stocks really doing well. The local stocks, a couple of weeks after that torrid time retailers had in the first quarter.
Yeah, look, I mean, I think again, this is now, select rebounding off very depressed levels. We kind of saw the earnings updates coming out throughout the course of the first quarter, and they were absolutely, dismal with, the majority of retailers actually seeing volumes going backwards. In other words, growing their revenues below what the internal inflation rate was. So their volumes were going backwards. Whether it was Woolies or Mr. Price or Massmart, which was just a complete disaster, or even Shoprite, which was thought to be the darling of the market and thought to be one of the highest quality retailers or highest quality stocks on the JSE, even that taking a battering. So look, I mean, I think that there's some technical buying happening because these shares have been fairly depressed, and then also the rand has been somewhat on the ascendancy since the start of April, probably about 2.5% stronger, and that is obviously going to be good for the banking and retail shares when we see that stronger rand.
What do you think of Clicks? I mean, impressive interims yesterday, the share price leaping. Again, it continued in that fashion today, 6.1% up. The market is keeping the optimism for the share.
Yeah, 100%. Look, I mean, if we look at so they grew headline earnings by just in excess of 12%. And I think that's a really impressive number. As I mentioned, if you look at Massmart, for example, earnings were down 30%. Shoprite was down 25%. Mr. Price was very flat in terms of headline earnings. Woolies was flat to slightly negative in terms of headline earnings. So this is a really impressive number in what's been a really difficult environment. And the market has always seen Clicks as the higher quality operator within that retail sector, and that's why it's always traded at a premium to the other retailers. So to give you an indication, you're talking about a PE multiple somewhere in the region of around, between 25 and 30 times, depending on which market cycle you're in, which has been a big premium relative to the rest of the market. So Clicks has always been the darling in terms of generating high levels of cash management, making very good capital allocation decisions. Very interesting to see in their results, actually, that, bucking the retail trend, where other guys are shutting down stores, they're looking to open 41 new stores this year and, powering ahead to getting to 900 stores within the next 5 years, currently at 640 stores. So, typically a very conservative management team under David Neal, new CEO taking over at the start of this year, and under him really accelerating that plan to open those new stores and capture the consumer market in the 60-plus age group, which they believe is going to be the fastest growing consumer market. But they have made solid capital capital allocation decisions before, and I think the results are evidence of that, and the market having confidence that you know, they're going to be able to pick up retail space quite cheaply given how depressed the economy is, and you know, it's going to be capital well spent given the track record in terms of deploying capital.
And then this week, Tiger Brands saying that it plans to fight this class action suit leveled against it for this deadly listeriosis outbreak last year. What do you make of this entire debacle? I see the share price is up today, by the way.
Yeah, look, I mean, I think that's you know, it's going to be a back and forth. If you ask me personally, I think there's going to probably be an out of court settlement on this. But the bottom line is that you know, Tigers has been a share that's been under pressure for a long period of time. You know, and I think that there was obviously a number of factors which contributed to that. The drought and, you know, food inflation really kind of bit them hard, and now the retailers are really squeezing them because the retailers are feeling the pressure of a consumer under pressure. So that isn't helping, but their margins are certainly widening up after, you know, the drought has been alleviated. Crop prices have come down quite a bit. Apart from wheat, crop prices have come down quite a bit, so that's going to be positive for the food retailers. So look, I mean, I think structurally there's some tailwinds for the food retailers, you know, where a number of one-offs that hurt their numbers kind of 2016, 2017 are out the system now. And it's going to be interesting to follow how this listeriosis story goes, because that could derail the Tiger story. But, you know, outside of that, you know, they're a fairly high-quality company. You know, once they kind of got out of their Africa operations, which were a disaster, you know, their local businesses, they hold a big monopoly in a lot of those, and they have some strong free cash generation. They typically did trade at a premium to the rest of the market and the other food retailers because they were the quality play. That kind of fell apart after the listeriosis outbreak. So I think the company is going to look forward to putting this behind them and kind of growing, you know, their brand presence and seeing the margin improvement translating into better bottom line numbers ultimately.
There were some nosebleeds into Africa. Nadir, thanks very much indeed for coming in and giving us those market insights. Now, that was Nadir Token, analyst for 27four.